Welcome to the Nadex Application and Strategy Webinar Series presented by Daryl Martin from apexinvesting.com. Today we're going to talk about the oil contract specs. We're going to go into future oil contract specs, Nadex spread crude oil contract specs and basics, and we're going to go into Nadex binary crude oil contract specs and basics. Nadex crude oil spreads and Nadex crude oil binaries are derivatives of the CME NYMEX crude oil futures, symbol CL. A derivative is simply an instrument where the price is derived from something else, like a mortgage is a derivative of a house. It is really helpful to understand the basics of the underlying instrument that the product is derived from when you're trading a derivative. So let's go ahead and look at the future oil contract that the Nadex spreads and binaries are derived from. The name is the NYMEX crude oil futures. It's also known as light sweet crude oil. It's light due to the low density and it's sweet due to the low sulfur content. It's lighter and sweeter than Brent crude oil, Dubai crude, and Oman crude. It's also known as WTI crude, West Texas Intermediate. It's processed mostly in the Midwest and South of the United States, and much of the delivery is done out of Cushing, Oklahoma. The contract size of one future contract is 1,000 barrels of oil, and it's priced in dollars and cents per barrel. For example, a quote of $91.10 for oil is the price of 1 barrel. The contract is for 1,000 barrels. Therefore, the contract's value is $91,100. The tick size and the value of the contract is pretty simple once you understand that it's 1,000 barrels of oil. The minimum increment that the quote moves in is 0.01. That's also known as the tick. It is quoted in a single barrel, and the contract is 1,000 barrels like we said. Therefore, a tick is worth $10, or 0.01 times 1,000 barrels, which would be $10 a tick. Also, there's something in futures contracts you need to be aware of called a limit move triggering event. If trading of the oil contract moves more than $10 per barrel up or down from the previous day's settlement price, then trade is actually halted on oil for 5 minutes. If the oil contract is held by the trader past the last trading date and through the delivery date, then the buyer is expected to take delivery of the oil, the 1,000 barrels of oil, and the seller is expected to deliver the 1,000 barrels of oil. The symbol future for the future is CL. And the exchange that CL is traded on is the CME, or Chicago Mercantile Exchange, which is the owner of the New York Mercantile Exchange. CL is traded on an open outcry on the NYMEX floor and is traded electronically on the Globex. The Globex trading hours for the CL contract is from Sunday through Friday from 6 p.m. to 5:15 p.m. Eastern Time. And there's a 45-minute break in trading each day beginning at 5:15 p.m. Eastern Time. The open outcry is from Monday to Friday, 9 a.m. to 2:30 p.m. This is where the floor traders trade it. In futures, you have contract months, and oil is traded for every single contract month. And here's the chart showing the symbol and the month. This is helpful to understand what the symbols are, because in some trading platforms, you'll need to know the symbol in order to be able to bring up the contract. And the way that it works is you actually combine the future symbol with the month and the year. For example, CLF3 to bring up the oil contract for January of 2013. The most liquid contract will have the most trading volume on it. And you can look on the CME's website and you can actually look at the quotes section and see what contract currently has the highest trading volume. In this instance, you can see that the February 2013 contract had over 107,000 contracts traded, much higher than any other month. Therefore, it is the most liquid contract trading month and is considered the active contract. When trading on futures, you're asked to put up margin. Margin is the amount of money you must deposit to trade a position. The initial margin set by the CME is $5,610. This is the amount of money you have to open a new long or short position on oil. Maintenance margin is $5,100, and this is the money required to keep a position open. In addition, many brokers will offer day trading margins ranging from $1,000 to 25% of initial margin, which is a little over $1,400. And the start times on day trading may vary by broker, but in all instances, all open contracts must be closed before the market closes each day, or you must have the maintenance margin in effect in your account. You must have that much money in your account to keep the position open. There's also variation margin, which is, in addition to the above margin requirements, the contract is mark to market, so profits and losses are added and deducted from your account balance live as the market fluctuates. And margin requirements may change if volatility spikes, requiring more money to be put up immediately. The combination of maintenance margin leverage and variation margin mark-to-market pricing can lead you to losing more than what you have in your account if there's a large move in oil due to news, or it just moves, or an overnight or over weekend movement. In many cases, this provides leverage, such as whenever you're trading oil, you can control $96,100 if oil is quoted at $96.10, with only putting up $1,000, giving you a 96.1 to 1 leverage. However, a margin call can occur if your balance drops below the margin requirement and the position is shut down or demand for additional deposit is made by the clearinghouse. And again, the margin call may not happen except in the instance where they close it down and ask you to put money up. But if you don't have the money in the account, you still could end up owing more than what is in your account. One of the great advantages of trading on Nadex is you'll never receive a margin call. You can never lose more money than what's in your account because whatever the risk is on the trade is the amount of money you must place up front, and your risk will never increase past that amount. The CME's crude oil future contracts are a derivative that is derived from crude oil. Well, Nadex's crude oil spreads are also derivative. They're priced from something else. That something else is the CME's CL futures contract. It's not only derived from CL, but it's derived from a specific month of that futures contract. And the month contracts that is derived from is listed in the contract name inside the Nadex platform, and that helps you avoid any confusion knowing what contract it should be following. Such as right here, you can see where February is the current contract month of the crude oil spreads as of the date of this recording. Nadex crude oil spreads allow you to trade crude oil with a contract that trades very similar to the underlying, requires less money to trade, has limited risk. Your risk will never increase as your margin is your maximum risk. You have no fear of being stopped out by a market spike because you have until expiration of the spread to be correct about price movement and direction. You have no fear of a margin call because your risk is capped as all trades risk is fully collateralized, so you'll never receive a margin call and you'll never lose more than what is in your account. And you have no fear of having to make or take delivery of a commodity like oil. Nadex oil spreads tick in 0.01, just like the underlying CL futures contract, except for every tick on a Nadex spread is worth $1. Well, as you recall, the CL contract ticks in 0.01, but every tick is worth $10, because remember, it's 1,000 barrels of oil. So it takes 10 Nadex crude oil spreads to have the same tick value fluctuating in the crude oil spread to be the same as a CL futures contract tick fluctuation. And you can get that by simply 0.01 times $1 per tick times 10 Nadex oil spreads equals $10 a tick, just like on an oil contract. So now let's look at the risk and potential profit when buying and selling a Nadex crude oil spread. Well, if we buy this spread right here, the way that we figure that out, and the simplest way to figure it out, by the way, is simply clicking on the offer or the bid and putting in a size of 1. By doing that, it'll actually calculate on the Nadex platform for you automatically without you doing any math, the potential risk and the potential profit of a trade. So when buying it, we look at the price bought minus the floor. So price bought minus the floor. Here's the floor and here's the ceiling. We divide that by 0.01. We multiply times $1 per tick times the number of contracts sold. So in this instance, if we bought it for $91.54 and we minus it from the floor of $91.25, we get 0.29. Well, if it's ticking in 0.01, that means that's 29 ticks. Every tick is $1. So our risk is $29 times one contract, or $29 total risk. Since the risk is $29, the margin is only $29. The risk will not increase beyond $29 no matter how far the market moves against you, and you have until expiration to close the trade for it to actually move in your direction. For the profit potential of a spread, what we do is we take the ceiling, which is $95.75, and we minus it from the bought price, which is $91.54. And we divide that by 0.01. So $92.75 minus 91.54 is $1.21. Divided by 0.01, the tick size, gives us 121 ticks. And then we multiply that times $1 per tick, and we get $121 times the number of contracts, in this case 1. It's $121 profit potential. So, and this gives you the profit potential of $121 on a $29 risk. And it is important to remember, you can close the spread at any time between opening and expiration. If you hold it to expiration, it'll automatically settle, and the difference between where you bought and the expiration settlement price will result in your net profit and loss. But again, your net loss will never exceed $29, your net profit will not exceed $121. So now let's look at the risk on a sold Nadex crude oil spread. What we do is we take the ceiling, $91.25, minus the sold price of $90.97, and we get 0.28. We divide that by the tick size, 0.01. We get 28 ticks times $1 per tick, and then times the number of contracts, in this case 1, it means a $28 risk. And again, since the risk is $28, the margin is only $28, and the risk will never increase past $28 no matter how far oil moves against you on the trade, and you'll have until expiration to be right and to potentially close out the trade. And again, as a reminder, if you simply click on bid and choose a contract size of 1, the platform will automatically calculate this for you. This just helps you understand where that calculation comes from. So if you sold this contract, what would the profit potential be? So what we do is we take the sold price, $90.97, minus the floor of $89.75, and we get $1.22 divided by the tick size, 0.01, and we get 122 ticks, times $1 per tick. So this spread right here has a profit value, potential value of $122 times one contract in this case for $122 profit potential, giving you a profit potential of $122 on a $28 risk. And again, you can close the spread at any time before expiration. One of the questions I often get is, are you able to set the floor and the ceiling, or are they set for you? And how is it determined? And is it random? Does it change each day? Things like that. Well, no. Nadex automatically has it set. And what they do is they have several times that new spreads start up. It gives you a lot of different trading opportunities, so you can find a spread with a floor or a ceiling close to where the market's at to give you a risk reward that you're potentially looking for. And what they do is they have 2-hour long spreads. And what they do is they're 2 hours long. They start at 8 a.m. So they go from 8 to 10. Another one will start from 9 and go to 11. Another one will start with 10 and go to 12. And then 11 to 1 and 12 to 2. And if they're $1.50 wide or 150 ticks wide, and they'll put one $1.50 where the market is up to $1.50 above it, where the market is to $1.50 below it, and then one that's straddling it, basically 75 cents above and 75 cents below, where the market is trading right around where the spread starts trading, the time it starts trading. So whatever it's priced at right around 8 a.m. is where they'll set the strikes. And they'll do the same thing. They have another 3-tiered spread that's 6.5 hours long. They have a daily one that's shown us as $5 wide, and they have what's called the master spread. It's the widest spread, and that's $10 wide, and there's only one master spread. One thing you'll often notice is the master spread is often trading very close to or exactly at the underlying market's price. And below here are the times that they're trading. You can also find this on Nadex.com under range of markets. Click on any one of the markets and then click on contract specs to get the specific details for any Nadex contract. One of the other things that's important to point out is the longer that the spread trades, the wider it is. So as you can notice that the 6.5 hour spreads are $3 wide, whereas the 2 hour spreads are only $1.50 wide. The daily ones that start as early as 6 o'clock in the evening and go to 2:30 the next day are $5 wide. And again, the widest spread, $5 above and $5 below the market, $10 wide total, starts trading at 6 o'clock and goes to 2:30 the next day, Monday through Friday. In addition to being able to trade Nadex crude oil spreads, you can also trade Nadex crude oil binaries. And Nadex crude oil binaries allow you to trade crude oil with a contract that can be used in both flat and volatile markets, require less money than trading a futures contract, have completely limited risk as your risk never increases as your margin is your maximum risk. And you have no fear of being stopped out by a market spike because you have until expiration of the binary to be correct about the price movement and the direction. Also, you have no fear of a margin call since your risk is capped, as all trades are fully collateralized, and you will never receive a margin call and therefore will never lose more than what's in your account. And you have no fear of having to again make or take delivery of a commodity like oil, like when you trade an oil futures contract. Nadex binaries are essentially a true or false statement, and you're saying that the statement is true if you buy. For example, crude oil, the February contract, will be greater than $92.22 at 2 p.m. Eastern Time. Or if you sell, you're saying that the statement is false. So crude oil February contract will be $90.22 will be less than or equal to, and that's very important, less than or equal to $90.22 at 2 p.m. Eastern Time. So if you sold this, That's what you'd be saying. If you bought it, you'd be saying that the statement is true. So, again, one important thing is that you can close the Nadex binaries before expiration, so the statement does not have to be true or false at expiration for you to potentially profit on a trade. And all Nadex binaries have a maximum value of $100 and a minimum value of 0. So if the binary is held to expiration, it's either going to be worth 0 or 100. It must be in the money to be profitable. So an in the money binary in a buy means that the Nadex settlement price for the CL futures contract is greater than the strike at expiration. And in the money on a sell means that the Nadex settlement price for CL is less than or equal to the strike at expiration. All right, so let's take a look at an example if you bought a binary. And what we're looking at is we bought this binary right here for $4, saying, and again, by buying, we're saying the statement is true, which is that crude oil February contract will be greater than $92.22 at 2 p.m. Well, the offer shows us our risk when we're buying. So $4 risk. The profit potential is $96 because every binary is worth $100. So $100 minus an offer quote of $4 shows us our maximum profit potential. The margin to this trade is going to be our risk, which is $4, for the potential to make $96 on the trade. Now, if we bought, say, the next binary down, and again, by buying it, we're saying the statement is true. We're saying that crude oil futures contract February will be greater than $91.22. Well, the offer on this contract is $58.50, so therefore that is the risk, and our profit potential is $100 minus the risk, or $41.50. The margin, again, will be the risk, so the margin of this trade is $58.50. Now, if we were to sell a binary, we went in and we decided we were going to sell this $90.22 strike binary, then we're saying that the crude oil future contract for February will not be false, greater than $90.22. So we're saying it will be less than or equal to $98.22 at 2 p.m. is what the crude oil February futures contract will be priced at. The profit potential on this trade is our bid quote. So again, when you're buying, the offer shows you the risk. When you're selling, the bid shows you the profit potential. So the profit potential is $96. So we simply look at that and go, okay, what's our risk? Our risk is $4. Remember, $100 maximum value minus the bid quote of $96. That shows us our risk of $4, and the margin to the trade is $4 with a profit potential of 96. Now, if we looked at a different binary, and we said, okay, we're going to sell that $91.22 binary. So instead of saying it's true, we're going to say it's false. We're saying it'll be less than or equal to $91.22. Well, the profit potential on this trade is $52.50, and the risk will be $100, remember maximum value, minus the bid quote of $52.50. So our risk on this trade is $47.50. Therefore, our margin to the trade is $47.50. And don't forget, you can always close the binary before expiration, so long as there is a quote on that binary. Nadex crude oil binaries offer you a lot of different trading opportunities. There's 3 new binary strikes released every hour, starting at 8 a.m. at 8, 9, 10, 11, and 12. And the difference between the strikes will be $1. There's also 23 strikes trading on the daily binaries that are only 50 cents apart on the strikes. And on weekly, they're $1 apart, and there's 13 strikes available. Again, you can access all this information on Nadex.com under Range of Markets, and then click on Commodities, and then click on Contract Specs. So in summary, Nadex crude oil spreads and binaries allow you to trade crude oil with less money, with limited risk, because your risk can never increase past your margin. There's no fear of being stopped out because you have until expiration for the spread or the binary to be correct about price movement and direction. You have no fear of a margin call because your risk is fully capped and fully collateralized up front, and you have no fear of having to make or take delivery of a commodity. To open a live or demo Nadex account, simply go to Nadex.com today. Also, visit us at apexinvesting.com to learn more about how to trade Nadex binaries and spreads.